Most traders think the problem is strategy. They think it's timing, or entries, or indicators that need to be adjusted one more time. Very few suspect that the thing hurting them most is the size of their position. Not because it's too small, but because it's too large. This story begins with a trader who did almost everything right. He studied markets seriously. He respected risk in theory. He avoided obvious mistakes. And yet, year after year, his results were mediocre at best. Not catastrophic, not impressive either. He would have a good month, then give most of it back. He would feel close to consistency, then drift away from it again. If you had asked him what the issue was, he would have said discipline, or patience, or market conditions. He never would have said position size. That blind spot cost him 8 years. Here's the part that matters. When he finally reduced his risk per trade by roughly 70%, his returns improved. Not slightly, meaningfully. The same setups, the same markets, the same rules, just smaller size. This sounds simple, almost insulting, and that's exactly why it's hard to accept. Because in markets, effort is rewarded inconsistently, but ego is punished consistently. Most traders carry an unspoken belief. If the trade idea is good, size should reflect confidence. That belief feels rational, it feels earned, and it feels deadly. This trader believed it too. He believed that trading smaller meant thinking smaller, that it meant playing not to lose, that it meant giving up on real progress. So every time he considered reducing size, another thought followed immediately. If I do that, what was all this for? Years of study, years of screen time, years of losses absorbed in the name of learning. Reducing size felt like admitting that all of it hadn't worked. That emotional resistance kept him stuck far longer than any technical mistake. Here's something most people never articulate. Position size is not just a number. It's identity. It reflects how seriously you see yourself. It reflects how much pain you think you deserve to risk. It reflects how quickly you want the market to validate you. When you size too large, you are not being aggressive. You are being impatient with reality. This trader didn't see that at first. He saw size as leverage on insight. If the read was correct, size would accelerate progress. But markets don't reward insight, they reward survival. That lesson usually arrives late, and it usually arrives expensively. For 8 years, his equity curve told the same story. Sharp upswings, deep drawdowns, long periods of emotional exhaustion. Every drawdown felt personal, because the size made it personal. Losses weren't just losses, they were judgments. Each losing streak carried a silent question. If I'm so experienced, why does this still hurt this much? That question quietly corrodes confidence. Not the loud kind of confidence, the dangerous kind. The kind that makes you hesitate when you shouldn't and push when you should step back. Eventually, something broke. Not the account, the narrative. After a particularly frustrating year, the trader did something that felt wrong to him. He cut his position size drastically. Not 10%, not 20%, 70%. It felt like overcorrection. It felt like retreat. And most of all, it felt humiliating. That emotional reaction was the real signal, not the math. When your ego resists a risk decision, pay attention. The immediate effect was uncomfortable.
Profitable trades felt insignificant. Wins didn't deliver relief, they barely registered. But losses changed character. They stopped dominating his thinking. They stopped hijacking his sleep. They stopped triggering the need to make something back. The market became quieter, not externally, internally. That silence revealed something important. Most of his previous mistakes weren't analytical. They were emotional reactions to size-induced stress. Overtrading, revenge trades, early exits, late entries, all of them traced back to the same root: too much risk per decision. With smaller size, his decision-making stabilized. He followed his rules more consistently. He held winners longer. He stopped interfering with trades that didn't need his involvement. Nothing about his intelligence changed. Nothing about the market changed. Only the psychological load per trade. And that changed everything. This is where many listeners disconnect. They hear this and think it only applies to beginners or undercapitalized traders or people who lack confidence. That's a convenient misunderstanding. In reality, the longer you trade, the harder it becomes to reduce size. Because experience creates expectation, and expectation demands compensation. You don't just want to be right, you want to be rewarded for how long it took to get there. That's the trap. The market doesn't care how long you've been studying it. It doesn't pay back time. It pays correct risk decisions. The trader in this story didn't increase returns because smaller size improved his edge. He increased returns because smaller size allowed his edge to actually function. That distinction matters. An edge under emotional strain is not an edge. It's a liability. Most traders never test this properly. They reduce size temporarily after losses, then scale back up as soon as confidence returns. They never experience what stable decision-making feels like over a full cycle. This trader did, and once he saw the difference, he couldn't unsee it. The hardest part wasn't the math. It was accepting that the thing he resisted most was the thing he needed longest. Reducing position size didn't make him less serious. It made him precise. It didn't slow his progress. It removed the friction that had been stalling it for years. This is the disruption most traders avoid, because it threatens the story they tell themselves about who they are in the market. And in trading, the stories you protect are often the ones you cost the most.
The realization didn't arrive as a breakthrough moment. There was no sudden confidence, no sense of relief, just a slow, uncomfortable awareness that his previous framework had been wrong. Not flawed, wrong. For years, he believed volatility in results meant volatility in markets, that inconsistency was an external problem. Reducing size forced a different conclusion. The inconsistency had been internal. This was difficult to sit with because it reframed past effort in a painful way. He wasn't unlucky, he wasn't early, he wasn't misunderstood by the market. He had been overwhelming his own decision-making. That realization creates resistance. When traders hear this, they often ask a technical question: how small is too small? That question misses the point. The real question is this: at what size do my decisions stop feeling urgent? Urgency is the enemy here. Urgency compresses time. It narrows perception. It turns probability into certainty. At higher size, every tick feels informative. At lower size, price becomes data again. That shift is subtle, but it's decisive. Before reducing size, this trader was constantly negotiating with himself. Should I hold this a bit longer? Should I cut this early? Should I add here?
Each trade became a conversation, and conversations create fatigue. After reducing size, those conversations quieted. He still fought, but he stopped arguing. Rules became easier to follow because they stopped feeling punitive. This exposed another uncomfortable truth. His previous confidence was conditional. He felt confident only when the market agreed with him quickly. That's not confidence, that's relief. True confidence doesn't require immediate confirmation. It requires tolerance for uncertainty. Large size destroys that tolerance. When too much is at stake, uncertainty becomes intolerable, and intolerable uncertainty demands action, usually the wrong action. The trader began to notice patterns he had missed before, not in charts, in himself. He noticed that most of his worst trades happened after winning streaks because size had crept back up, quietly, rationally. He noticed that his best decisions were often boring. They didn't feel bold, they felt obvious. That bothered him at first. He had equated intensity with effectiveness. Smaller size removed intensity. What remained was process, and process doesn't feel heroic. This is where many traders turn back because the market stops feeding the ego. Smaller size removes drama, and drama is addictive. Large wins feel meaningful. Large losses feel consequential. Both give the illusion of progress, but illusion is not equity growth. This trader had to confront a deeper belief that trading should feel difficult, that struggle meant engagement, that stress meant seriousness. Reducing size made trading feel almost too easy. That felt suspicious. Ease is often misinterpreted as laziness, especially by people who equate effort with worth. But markets don't reward effort, they reward alignment. The trader realized something else during this period. His analytical skill had always been adequate. What had been inadequate was his emotional bandwidth. Every trade consumed too much of it. Smaller size conserved bandwidth. That conservation had compounding effects. He could wait longer for setups. He could skip marginal trades without discomfort. He could accept missed opportunities without frustration. These behaviors had always been written in his rules. They had never been lived, because the size made them impossible to execute consistently. This leads to a difficult insight. Most trading rules are correct in theory. They fail in practice because position size makes them unbearable. Rules that feel reasonable at 1% risk feel impossible at 5%. The math doesn't change, the psychology does, and psychology always wins. As months passed, the results stabilized, not spectacularly, reliably. Drawdowns became shallow, equity curves smoothed, but more importantly, the trader stopped thinking in streaks. He stopped labeling weeks as good or bad. He stopped measuring himself daily. That shift mattered more than performance because it removed emotional accounting. Emotional accounting distorts risk. When you're ahead, you feel entitled to press. When you're behind, you feel pressure to recover. Both behaviors amplify volatility. Smaller size neutralized that impulse. Each trade returned to its proper scale, one decision in a long series, not a referendum on competence. This reframing unlocked something critical. He stopped trying to prove anything to the market. That need had been invisible before, but once gone, its absence was obvious. He no longer needed trades to validate his experience. He no longer needed wins to justify past losses. The market became a place of execution, not affirmation. This is the realization most traders avoid, because it implies that trading success is less about conviction and more about restraint. Restraint is not glamorous. It doesn't signal expertise. It doesn't impress observers. It just works. The trader began to understand why this change took 8 years. It wasn't ignorance, it was identity protection. Reducing size meant redefining what it meant to be skilled. Skill was no longer measured by how much he could withstand. It was measured by how little he needed to. That inversion is psychologically expensive, but once made, it doesn't reverse. He could see his past clearly now. All those years weren't wasted, they just led to the wrong conclusion. He had learned how markets moved, he hadn't learned how he reacts. Position size bridged that gap, not as a risk control, as a self-control mechanism. This realization didn't end his struggle, but it changed its nature. He was no longer fighting the market, he was calibrating himself. And that calibration set the stage for something most traders never reach: consistency without exhaustion.
Consistency without exhaustion changes how trading fits into a life. It stops dominating attention. It stops leaking into unrelated decisions. It stops demanding emotional recovery after every session. That was the final shift for this trader. Trading became quieter, not easier, quieter. He no longer measured progress by excitement or disappointment. He measured it by how little he had to intervene. That metric would have confused his earlier self. Earlier, involvement felt necessary, engagement felt responsible. Now he could see the difference between involvement and interference. Smaller size reduced the cost of patience. Waiting no longer felt like wasted time. It felt like part of the work. This is where application begins, not with formulas, with observation. If you want to know whether your position size is too large, don't look at returns, look at behavior. Do you feel pressure to check positions repeatedly? Do you feel compelled to act when nothing has changed? Do you feel relief when a trade closes, regardless of outcome? Those are not market signals. They are size signals. Another test is even simpler. Ask yourself how you feel about missing a trade. If missing a trade feels painful, your size is too large, because opportunity should never feel scarce. Only execution should matter. The trader learned to reduce size not as a punishment, but as an experiment. He committed to a full cycle, not a week, not a month, a full cycle. That commitment mattered. Temporary size reduction teaches nothing. It just delays discomfort. Sustained reduction reveals patterns. It reveals how often you trade out of boredom, how often you trade out of fear, how often you trade to feel involved. Those impulses don't disappear. They become visible. Visibility creates choice. This trader didn't become passive. He became selective. Selectivity increased returns, not by increasing winners, but by reducing self-inflicted damage. That's the part most people misunderstand. Improvement didn't come from better predictions. It came from fewer mistakes made under pressure. Pressure is proportional to size. This isn't theoretical, it's mechanical. When the cost of being wrong decreases, the need to be right softens. That softness improves decision quality. The trader eventually rebuilt size, but slowly, deliberately, and not back to where it had been. He stopped asking how much he could make. He started asking how much clarity he could preserve. That question changed everything. Clarity compounds. It compounds in discipline, it compounds in patience, it compounds in trust in one's own process. Most traders chase compounding returns. Few chase compounding clarity. The irony is that clarity is what allows returns to compound in the first place. There's a final misconception worth addressing. Reducing size is not about fear. Fear already exists. Size just amplifies it. Reducing size is about honesty. Honesty about how uncertainty feels. Honesty about emotional limits. Honesty about the difference between confidence and hope.
Hope is loud. Confidence is quiet. The trader didn't lose ambition by trading smaller. He lost desperation. Desperation is expensive. It leads to rushed decisions. It leads to oversized bets. It leads to narratives that justify unnecessary risk. Removing desperation removed noise, and in markets, noise is lethal. This story isn't about a specific percentage. 70% is not a rule, it's a reference point. The real lesson is this: your optimal position size is the one that allows your rules to be followed on your worst day, not your best. Most traders size for confidence. Professionals size for stress. That difference explains the gap in results. The trader understood something late, but fully. Markets don't reward boldness, they reward endurance. Endurance doesn't come from toughness, it comes from calibration. When position size matches emotional capacity, trading becomes sustainable, and sustainability is what produces longevity. Longevity is what allows skill to express itself. That's the resolution most never reach. They search for better strategies, they optimize entries, they refine exits, all while carrying a position size that sabotages every improvement. This trader learned the opposite sequence: reduce size first, stabilize behavior, let skill surface naturally. It took 8 years because it required letting go of an identity, the identity of the aggressive trader, the serious trader, the trader who needed big size to feel legitimate. Letting go of that identity felt like loss. In reality, it was subtraction, and subtraction created space. Space for better decisions, space for consistency, space for returns that didn't demand emotional payment. That's why reducing position size increased returns. Not because smaller is safer, but because smaller is honest.